Hello, today I'd like to show you a way how you can actually reduce your loan balance by over 23% without making one additional penny payment on your monthly payment. Okay, many of you have heard of this, maybe some of you have not. This is something that's relatively new in the industry, and what it's called a bi-weekly payment. Okay. Years ago, maybe 10, 12 years ago, right around there when it was first introduced, they used to have holding companies do this for you that would allow you to save a lot of money on your interest payment, and in turn they would make the calculations and make the payments to the bank. And there was laws that went into effect where the banks could not refuse to take the payment that way. However, with the economic trends the way they've been in the last couple of years, this has become real popular within the last 5 years. And basically what it is you make, let's say if your payment is $1,000 a month, you, instead of making one payment of $1,000, you make two payments of $500, okay, every 2 weeks. What that does is that cuts the amount of interest in half, because instead of allowing 30 days for that interest to yield and get larger, you're cutting it in half at 15 and then starting all over again for the final 15 days. And just as this shows, this is principal, this is interest, okay? These are the number of years of a loan. This is based on a 30-year loan. Okay, as you can see, year 15 right in the middle, all this in here is the amount of principal. However, when you go from here all the way across over here, all this is the amount of interest you're paying. So that's why usually when you borrow, let's say for every $100,000 you borrow, you pay back close to 3 times that amount over the entire life of the loan, because it's all interest. That's why the first year there's very little principal being paid off, and as you can see it's all interest, whereas it flip-flops. This is amortization. On the 30th year there's very little interest, it's all principal. Okay, so that's how that works. And to give you some examples how the bi-weekly works, at the end, if you borrowed $100,000 at 5% interest amortized over 30 years, your payment is going to be $536.82, something like that. Let's just say $537, okay? After you make that $537 payment, you make 12 of them at the end of the year. If it's a regular 30-year loan, your loan balance is going to be $98,524, okay? If you take that payment and cut it in half and pay it every 2 weeks, your loan balance is going to be $97,987. Since the first year is mainly interest and not a whole lot of principal anyway, you're saving an additional $537 over more than you would on a regular 30-year loan. Now, as the loan matures and it gets older, that's when you really see a big, huge difference in the amount of interest that you pay, and your principal starts getting more and more to paying off that loan, which is called equity or equity buildup. For example, at the end of year 5, you're on a regular 30-year loan, and which it is. This is a 30-year loan. It's just making the payments twice. Your balance is going to be $91,828, whereas if you took the same payment and did it on a bi-weekly, it's $88,855. So you would pay $2,973 less in interest. Here's where the magic really starts, however. Looking at year 20, okay, at the year of 20 years on a 30-year loan, you're still more than 50% of what you borrowed, because remember, you borrowed $100,000, okay, and here that's a 30-year loan, but on year 20, 66% into the payoff of the loan, you still owe over $50,000. Whereas on the bi-weekly, it's $32,000 instead of the $50. And you've paid almost $18,000 less in interest using the biweekly. Okay. Now, here's where the real magic is as well. At the end of year 26, using a regular 30-year loan, 5% interest on $100,000, your loan balance is going to be $23,310. Okay. Using the biweekly at the year 26, it's paid off. There's no more payment. Property's yours. So that's where you come up with the 23%. Okay, you saved over 23% by doing the biweekly. Okay, and it works the same way. When you're making the payment once a month, you can see how it matures, and you pay all this interest in here and less principal. By cutting it in half, what happens is now you only pay to here in interest instead of way down here. Okay, and it starts over again here, and so it doesn't get as much time to mature. Okay. Also, there's a way to get your monthly payments lower by offsetting that payment with tax exclusions. And on $100,000, your tax exclusion is going to be $115,000. On $200,000, I have 1, 2, and $300,000. It's $231 and $347 a month. Okay, so for example, at $537, if that's all you borrowed was $100,000, you can have your payment reduced every month by $115 per month. Okay, and still not change these numbers. Still have the same numbers. Now, as you can see, I got a bunch of numbers. This is kind of complicated. I hope you'd understand this. If you don't, you can always call me at 562-400-8123. Also, this part, the tax exclusion, is going to be different. There no two are exactly the same. However, these are pretty reliable figures here. So if you were interested in finding out how much of a tax exclusion you could qualify for, once again, give me a call. I'd be more than happy to sit down with you and go over this so you fully understand and show you exactly what your amount would be. But at 115, it's pretty safe. That's probably a minimum. If anything, I know for sure all these are actually higher. Okay, but there again, we've got a whole bunch of numbers here, and I'm throwing a lot at you, and I don't want to get you confused. So give me a call, and I'll be more than happy to clarify any questions you may have. Thank you.